Today in the Wall Street Journal, Monday, July 19th, 2021. OPEC and its Russia-led oil-producing allies agreed to unleash millions of barrels of bottled-up crude over the next years, committing to restore all the cuts they made in the start of the pandemic as many economies pick up and crude demand recovers. U.S. economy 2021 growth surge likely peaked in the spring, but a strong expansion is expected to continue into next year. Economists surveyed by the Wall Street Journal said some used cars are worth more than they were new as a global chip shortage curtails new vehicle production and losses and rental firms hold on to their fleets longer. The Netherlands, under pressure from the U.S., is withholding an export license that would allow China to buy a machine made by ASML that is essential to making advanced microchips. Zoom plans to acquire Five9, which provides cloud-based customer service software, the $14.7 billion in stock to help expand its offerings to clients. Ingersoll Rand has made a takeover bids for component maker SPX that have so far been rebuffed, according to the people familiar with the matter. Lawmakers dropped plans to pay for a roughly $1 trillion infrastructure package in part by boosting tax collecting enforcement at the IRS, a setback for bipartisan measure ahead of a looming deadline of agreement. Organizers of the Tokyo Olympics are grappling with a rising number of athletes and officials who are testing positive for COVID-19 upon arrival in Japan. The Inflation Tax on Capital, opinion page A17 by Aaron Friedman and Stephen Mirren. June's 5.4% inflation highlights one of President Biden's more damaging and exotic economic proposals to raise the top tax rate on capital gains. Nominally, he would pull it up to match the tax rate on ordinary income, but the real rate, taking inflation into account, would be so high that investors could dramatically change their behavior, badly harming the economy and job market. While soaking the rich might sound attractive, the president's proposal is more like drowning them. On paper, the president's proposal would raise the nominal capital gains rate from the current 20% to 39.6%, plus the Obamacare's 3.8% Medicare surcharge. Many investors who would be subject to the proposal live in places like California and New York, where the combined federal, state, and local tax rate would reach 56 and 58%, respectively. Capital gains taxes on corporate shareholders are already double taxed, since income is taxed at the corporate level before being remitted to the shareholders. The total federal, state, and local income taxes paid by corporations and shareholders on corporate income would be as much as 75% under the Biden proposal. That's all before inflation. Capital gains taxes apply to nominal returns. If you bought a stock decades ago for $100 and sell it today for $1,000, you'll pay taxes on $900 profit. Never mind that a substantial part of it reflects the dilution of the dollar's value. As inflation accumulates, savers' assets are driven up in price, but inflation-induced appreciation doesn't raise real wealth, which erodes as these phantom gains are taxed. This problem, which exists in the current tax code, could be solved by indexing the basis on which the gain is calculated. In our example, revaluing the $100 purchase price in 2021 dollars before calculating the profit. For the past 20 years, the nominal average annual total return on the S&P 500 index has been about 8.6%. If this continues in the future and the Federal Reserve succeeds in hitting its 2% inflation target, an optimistic prospect given wildly excessive fiscal policy this year, total returns after inflation will be about 6.6%. 58% tax on an 8.6% nominal return and the equivalent of a 76% tax on after inflation returns of 6.6%. An investor would keep less than a quarter after inflation gains. This risk calculus looks even dicier considering how the Fed has defined inflation. The central bank's definition, the price index on personal consumption expenditures, includes services the government pays for, like Medicare reimbursements to doctors, which have nothing to do with what Americans pay for out of their own pockets. The consumer price index, which relates more directly to what consumers pay for themselves and what Americans do it as the cost of living, tends to run about 0.4 points above the Fed's inflation measures. Using this more realistic understanding of the cost of living, the real marginal tax rate would be about 80.5%. And what if the Biden administration profligate fiscal policies into several years of disappointing equity returns? Excessive fiscal spending combined with the Fed's explicit policy of aiming the above target inflation makes it likely the U.S. will see some inflation overshooting, with, say, a nominal equity return of 7% and 0.5 point overshooting of the Fed's inflation target. This real marginal tax rate becomes an astonishing 99%. Reduce those equity returns to 6%, and the real rate becomes 112%, which eats into principal. If inflation continues at a pace near 5% without boosting nominal equity returns any higher than their longer-term average 8.6%, as high inflation tends to lead to poor performance, the real marginal tax rate jumps to an investment crushing 139%. Younger Americans are blessed never to have experienced the impact of high inflation, but they will suffer if policymakers ignore its potential dangers. The Biden proposal will hit families with average income as well as the wealthy. A household could invest in and hold an asset for decades, which appreciates in nominal value because of inflation. Even if the asset's real value were to remain the same, the gain in the sticker price value would be taxed, and the one-time sale could push them into a high capital gains bracket. Real tax rates this high would encourage savers to take money out of productive investments, making it more difficult for entrepreneurs and businesses to take risk and conduct operations. Fewer dollars funding businesses' operations means less jobs creation, innovation, and growth. And while the top tax rate would affect relatively few taxpayers, these taxpayers provide a disproportionate amount of savings and capital, which businesses use to conduct operations and pay employees. The wealthy can weather this economic stultification. The harshest impact will be on the poor and disenfranchised, the people the Biden administration purports to want to help. The real way to give those Americans a lift is by creating strong and sustainable demand for U.S. workers, as the previous administration demonstrated with its tax reform. Trade renegotiation, cuts to government regulation, boost to labor demand from stimulative government spending will eventually fizzle out, while the accompanying tax rate hikes will permanently harm job creation. Mr. Miram is a former senior advisor for economic policy at the United States Treasury. Mr. Friedman is a director and senior tax counsel at the Federal Policy Group and former senior advisor for tax policy at the Treasury. Well, all well and good. I think the truth is everything to discuss with tax rates is political and based on an agenda. This all seems to make sense, but it makes no sense when you think about it. What do for the average Joe, what happens? You take your money from your job, you put a certain percentage in a 401k, it grows tax-free. let's say you were able to put in $500,000 over the life of your retirement. Once you retire, you have, let's say, $2.5 million. You take that money back out as ordinary income when you retire, which is the exact same tax rate that you would have paid had, well, it's plus or minus depending on what political group is in power at the time, but for all practical purposes, let's say it's the equivalent. So now you're taking the money out at full ordinary income, which is exactly the same that you would have taken it out before. Based on this article, The Inflation Tax on Capital, where they try to make you feel as all your money will go away, makes no sense in reality.